From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network, and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. On the 30th anniversary, we look back at the single worst day in Wall Street history, equivalent to a 5,000-point drop in today's Dow. And it was not during the Depression and not during the 2008 financial crash, but it led to the road to future destruction on Wall Street. That's all tonight on Business Talk with Jim Campbell. Diana Henriques is the author of the New York Times bestseller, The Wizard of Lies, Bernie Madoff and the Death of Trust, which was made into an HBO film starring Robert De Niro, a financial writer for the New York Times since 1989. She's a George Polk Award winner, Pulitzer Prize finalist, graduate of George Washington University, which I always mention because my daughter went there, and she was a guest on our show for that great Madoff book. And the new one is A First-Class Catastrophe, The Road to Black Monday, the Worst Day in Wall Street History. Welcome back, Diana. Great to hear you.
Oh, Jim, it's great to be with you again.
So tell us first your Hollywood experience. You were actually drafted to be in the movie on your book with Mr. De Niro.
I was. It was my Cinderella moment. I kept thinking that the car taking me home was going to turn back into a pumpkin. I was a consultant to the HBO project, so I had been talking with De Niro about my experiences with Madoff, whom, as you know, Jim, from our earlier conversations, I had covered, decades before he got arrested. He didn't burst on my radar just in December of 2008. So, De Niro and I hit it off, and he apparently suggested to director Barry Levinson that I audition to be the reporter who interviews Madoff in prison, since I was the reporter who interviewed Madoff in prison. And I took a screen test to see if I could play myself, which was a kind of surreal experience. Passed the screen test and just had the most remarkable experience of being able to watch up close as one of the era's greatest actors built this personality. And if you've seen the HBO movie Wizard of Lies, you will see one of De Niro's greatest performances. He is, and I can tell you because I know both Niro and Bernie Madoff, he just occupies Madoff's brain completely.
Wow.
It is surreal
Wow.
how great that performance is. So I had a wonderful time.
And where do you keep your Oscar at home?
There was no category for best performance by a newspaper reporter playing herself.
That will be one of the great lines. I passed the screen test playing myself.
Yeah, I know. Well, what if I hadn't?
I was going to say that would have been
directly to the shrink, right?
All righty. Let's start off because we're now going back in history, and in the U.S., history is like breakfast. What was the overview on Black Monday? Was Monday, October 19th, 1987.
Market had been, as you'll remember, Jim, had been unsteady for months and absolutely bleak for 2 weeks. So going into Black Monday, what's interesting in reconstructing it is, a lot of people, a lot of Main Street people thought that this correction for this incredible bull market that had begun in August of 1982 was over. The first week in October was the worst week since 1929 until the second week in October, which was the worst week since 1929. And, people who were not plugged in to the new way Wall Street was working thought we were done. We'd had a substantial 40% climb in the course of 1987, and it had fallen sharply, and folks said, well, okay, we've had a normal market correction. But as John Phelan, the chairman of the New York Stock Exchange, had warned Congress repeatedly, the new toys, the new players on Wall Street had the capacity to turn a normal market downturn, a normal correction, into a first-class catastrophe. That was a quote from his testimony. And that's what happened on Monday, October 19th. The market just went into free fall, more selling than it could possibly absorb. And the next day, it almost broke down completely. So while many crashes in our history are important for what came after. Of course, the 1929 crash as the portal into the Great Depression, and the 2008 crisis as the portal into the worst hard time since the Great Depression. The 1987 crash to me was important because not of what was going to happen next, but because of what it showed us about what had already happened, the ways Wall Street had already changed. And it was those changes that set us on the path to 2008, and indeed on the path that we're still on now.
We had the long-term capital market crash that was really leverage-based and showed the linkage amongst firms, right? We had the Internet crash in '01 that drove the NASDAQ down 4,000 points over time. And then we had, of course, the September 15th Lehman. You don't see those in the same vein that you look at this? I mean, how do you put that all together?
Well, to me, what links them all together, if you look at it, Jim, were the four big components of the new world that Black Monday revealed to us. And one of them was the advent of the Titan-sized investor. You know, giant institutions, giant pension funds and endowments had never been regular players in the stock market. You know, they stayed in safer securities, mortgages, bonds.
Yeah.
It was in the late 70s when the interest rates went crazy that big giant institutions began to invade the stock market. They've never left. BlackRock and Vanguard together, two firms today, have under management $10 trillion in assets. So investors on that scale had never been a factor in stock market movements prior to the 1980s. So that's one big change that we're still coping with. It was a factor in the long-term capital management crisis in 1998. It was obviously a factor in the collapse of Lehman Brothers in 2008. Derivatives, financial derivatives that have untested, unexpected consequences were first introduced into the markets in 1982 with the S&P 500 futures contracts in Chicago. And they have multiplied like viruses all over the financial landscape, and they remain, whether they're regulated or unregulated, they remain the bolt from the blue factor in so many of our crises. It was foreign currency derivatives in 1998. It was credit default swaps in 2008. But still, financially engineered derivatives. And in both cases, you had the speed of automation, giving everyone less time to cope and react. And that certainly is the case today, as we learned with the flash crash in 2010 when the market fell, 1,000 points between 2 o'clock and 2:20. So the speed of automation is just it's a one-way street. And then the fourth and final point is the fragmented nature of our regulatory system, which was identified after 1987 as a danger and a risk. It was identified after 2008 as a danger and a risk. And the Trump administration's Treasury Department put out a report in October saying our fragmented regulatory system is a danger and a challenge. So if you look at the crises we experienced before 1987, they all pretty much resemble each other, going back to the Amsterdam tulip bulbs. If you look at the crises we've had after 87, they all resemble 87.
In fact, that pitch you just gave on those four reasons, you could have done that right the day after 2008.
Absolutely.
The exact same.
Absolutely.
So that's 30 years of American financial intelligence. Down
30
the
years of
toilet.
American financial amnesia.
Amnesia, yes. Tell folks a little bit about this was the emergence of the futures markets, the option markets in Chicago, and the exchanges in New York, the equity exchanges. And there's turf issues, there's the way they do business difference, and they were competitive. And of course, they then link things up to everybody ran to the exits all the time. Talk a little bit about what that is. Explain it.
Well, the financial engineering that had, I must hasten to say, many advantages for modern investors, nevertheless had some unexpected consequences, unforeseen consequences. One of those was the way giant investors could use financial derivatives, like futures contracts, like options contracts, to arbitrage investment opportunities between markets. we all understand arbitrage. If you can, buy gold in London and at $100 an ounce and sell it in New York for $110 an ounce, you can make money if you can do it at the same time and cover your transit costs. Same thing with stocks and stock futures. If you can buy shares on the New York Stock Exchange for less than that futures contract in Chicago, then you can profit from the arbitrage. And it took just a few months after the creation of these new derivatives in 1982 and 83 for institutional investors to figure out strategies, hedging strategies and speculative strategies that linked all these markets together. So regulators were still thinking that, options trade in this little silo, derivatives trade in this silo, or futures contracts, and stocks trade over here, when in fact the players in those markets were all the same people using strategies that linked all those markets together.
Perfect description. We'll get more into the path to the crash Black Monday next. And we're back with New York Times financial writer Diana Henriques. We're going to go through some of the events that led to Black Monday. But first, I want to give her a little bit more chance. Tell people, you just did a great job how things all came together and they learned to exploit price differentials in each of those markets while the government was sort of AWOL or didn't understand that or still hasn't understood that, how to regulate that. Tell people what program trading is, portfolio insurance, some of the things that ended up being triggers.
Right. Well, these were the shiny new toys of the 1980s market. I mean, the advent of computers on Wall Street made it possible for giant investors through their Wall Street firms to deliver massive orders into the marketplace almost instantaneously, faster than humans could really cope. Now, program trading originally began actually as a human scale process. If a big mutual fund or a pension fund wanted to buy a list of stocks all at the same time because they were suddenly bullish, say, on natural resources, they would contact their broker, and the broker would call the New York Stock Exchange and order, a list of, X many shares of all of these stocks. And the clerks would fan out like a covey of quail to all the different specialist posts on the trading floor and place those orders. And traders could see that happening, physically see it happening. And they knew that meant that there was a big buy order or a big sell order moving into the marketplace. Computers made that physical, human-scale process automated. It could no longer be seen and anticipated. So that process that was originally called program trading morphed into computerized program trading, where orders could be delivered automatically for large numbers of stocks into the marketplace via computers. Now, program trading was used in a lot of different ways, and I'm afraid that the business media of the era was pretty confused about it. We didn't do a very good job in explaining it to people at the time, but it could be used, for example, for that kind of arbitrage I was talking about earlier. In order to do that, you'd want to get the orders into the market as simultaneously as possible, and computers let you do that. It could be used for a variety of hedging strategies. If you, for example, needed to sell all your stocks and with a South African divestment strategy, you could do that using program trading. Or you could hedge, and one of the most popular hedging strategies of the 80s was something called portfolio insurance. And it was really just like a put. Your sophisticated listeners will know that a put is an arrangement that allows you to sell something at some point in the future at a price you fix on today. And the people using portfolio insurance were using largely the futures markets to sell their investments in a declining market so that they would reduce their exposure to the stock market as prices were falling. Well, looking back with 20/20 hindsight, you can see the flaw in that argument. You're going to be trying to sell into a downdraft, but the people who used portfolio insurance were convinced that because they were just hedging, no one would be frightened by their sell orders. They would say, look, we don't know anything about where the market's going. We're just selling because it's already gone down.
And then it basically exacerbated the moves up and down, right? I mean,
of course it did. Why would they think otherwise? But because one of the things that was happening while portfolio insurance was going viral among the institutional investment community was index funds were becoming more and more popular. And so as that happened, the big institutions began to behave more and more alike. You have the advent of the herd institutional investor. And, that's the world we're living in today with, giant index funds all likely to be doing the same thing with the same stocks at the same time.
It's scary.
And it is scary. It's everybody running over to the same side of the boat at once.
As you say, I think everybody's running for the exit at the same time.
Yeah.
And it's interesting, if you look at this, portfolio insurance morphed into things like credit default swaps, which brought down 2008, and all the computerized tradings morphed into dark pools, which has hidden it. So you get all this stuff that just sort of goes right from 30 years.
When I interviewed Jerry Corrigan, who was the president of the New York Fed during the crisis, and one of its unheralded heroes, really, when I interviewed him in 2015 for this book, he said to me, he right out of it, sat down at the conference table at Goldman Sachs, and he said, you can draw a direct line from 1987 to 2008.
And he was a hero in both those, right?
He was.
Yeah.
We were fortunate in '87 with the leadership that stepped forward to see us through that crisis. '87 really showed us, Jim, how much of coping with a crisis is psychological and emotional.
Yes.
Not mechanical, not regulatory. It requires an infusion of confidence. There's no rule book for how to deal with the next crisis, but I think this book, I'm not shy about saying, this book gives you an idea of what it takes to get us through. The luck, the pluck, the improvisation, the willingness to try something, abandon it if it doesn't work, and try something else. That's what got us through 1987. It was a far more near-run thing than we remember. Most people think of 87 as just, the crash without consequences. In fact, it was far more dire than we even knew at the time. So the
we have another
severity of the crisis was something that even I, as a business reporter at the time, was not aware of until I started digging into the background of the crash for this book.
Yeah, in fact, I would talk about it at the end, but it sort of puts a wrap around why Dodd-Frank won't necessarily work based on the improvisation you just said. Now, there's another big aspect to this time that ties right through here, which is too big to fail. Talk a little bit about the Continental Bank deal.
Yeah, well, that was an interesting thread in this story. Continental Bank was one of those accidental heroes on Black Monday in two ways. It owned, as a subsidiary, one of the primary options clearing firms in Chicago. And that firm was hit with an old-fashioned panic run.
Yeah.
Its customers started pulling cash out of that firm in the middle of Black Monday. And Continental Illinois Bank was able to to loan cash to that unit and keep it from collapsing, and therefore save the options market, basically, in the middle of that crisis. Similarly, the Chicago Mercantile Exchange, the leading futures market, where these S&P 500 futures that were so critical to all of these intermarket strategies were trading, was $400 million short of the cash it needed to open the day after Black Monday. And who came through with a last-minute loan over the phone, not even on a handshake? Continental Illinois Bank. So it became crucial to look back at Continental's history. And in 1984, Continental had almost failed. It became the victim of one of these electronic worldwide panics, a bank run. And the FDIC and the Federal Reserve joined forces to save Continental Illinois in 1984. The political environment in which that happened, a Republican administration making these decisions and explaining why they made those decisions, I thought was so informative to our current conversation about too big to fail.
And what hit me is they had all these purchase loans, almost hot money, that didn't have proper collateral, and then it was, they sold it, the Penn Square up to Continental, meaning again that nobody was managing risk; it was just being offloaded. We're going to get into the actual day next segment. We're back with Diana Henriques, the author of The First Class Catastrophe, actually a first-class catastrophe, The Road to Black Monday, the worst day in Wall Street history. And on that day, again, the market went down 22%, worst day ever. And we're going to go through it in some of the components now, but can you convey exactly what it felt like on the ground and in the C-suite with the executives and then in the halls of D.C.?
Well, it was... We have to remember that Black Monday was the Monday after a day that, if we hadn't had Black Monday, would have gone down in history as Black Friday. Friday, October 16th, was the first time the Dow had ever closed down more than 100 points. It closed down 108 points. And from 2 o'clock on, people I interviewed from trading desks remembered that it was essentially in free fall through that Friday afternoon. And they knew what was happening. The people who were using portfolio insurance and other hedging strategies were selling like crazy because the market had fallen so much in the 2 previous weeks. They knew by a rough calculation how much portfolio insurers would need to sell, and they knew that they had not come close to selling the amount they needed to sell on that Friday afternoon. So the professionals went home knowing that there was this pent-up flood of sell orders that were going to hit the markets the minute they opened on Black Monday. Now, that was different from the guy on the street. He thought that Black Friday was the end of it, that was the worst week ever. It was the worst day ever, that we were through the worst of it. But the people on the inside knew differently. They knew that they had to be braced on Monday morning for the worst ever. The market had fallen 108 points on Friday. John Phelan, the chairman of the NYSE, went into work that morning expecting the market to fall 200 points that day. Wow. It would be a 9% drop, second to nothing since 1929. He was braced. His traders were braced. That 9% drop had occurred by midday. The market had fallen 200 points before anyone could even get their breath. And the dance between New York and Chicago, this awful, vicious cycle that was forming where futures values for the S&P 500 would plummet, and that would push the stock price values down on the NYSE. The back and forth between Chicago and New York was accelerating. The volume of trading was breathtaking. By the end of the day, 604 million shares, which was a 50% increase in their highest day ever. So they were struggling to cope. Computers were falling behind. The public ticker was falling behind. The sell orders were overwhelming any buy interest at all. Now, there were some buyers that I interviewed for the book. I interviewed a stalwart pension fund manager at the state pension fund in New Jersey. When he realized what was happening that afternoon, he had about $200 million in cash he could put to work, and he wanted to buy some of these low-cost blue-chip stocks. He had trouble getting his orders into the market. He was the buyer of last resort, but he had trouble buying because the sell orders were overwhelming everything. By the end of the day, the market was down 508 points, 22.6%. As you said earlier, the equivalent of more than 5,000 points in one afternoon today. And John Phelan and his regulator, David Reuter at the SEC, and the chairman of leading Wall Street firms all huddled to figure out, can we open the next day? And Phelan furiously felt that they had to open on Tuesday. Similarly, in Chicago, the futures pits were devastated. They'd never seen anything like the declines. The New York market was down 22.6%. The S&P 500 futures market was down 27% in Chicago. So the next morning, they weren't sure they would be able to open, but everyone was determined to try to keep these financial markets running. By midday in New York, it was breaking down. There were not enough buy orders to even open trading in many of the big blue chip stocks. And to the extent that our financial markets almost broke, it was at that midday moment on Tuesday that they almost broke.
And you think it was close to a collapse?
I do.
And you think it was worse than '08's closeness to collapse?
Without a doubt.
Wow.
Because of the speed with which it was happening.
Wow.
And the lack of any awareness of what to do.
Wow.
You know, the fragmented nature of our regulatory system, to some extent, was short-circuited in 2008 because Ben Bernanke and Hank Paulson, the Treasury Secretary, Ben Bernanke, the Fed chief, kind of stepped outside the borders of their traditional authority and worked together to rescue AIG, an insurance giant, which neither one of them regulates.
Yes.
So, you know, they were willing to color outside the lines at high speed to save the system. But in '87, no one was even sure where the system was breaking down.
Was Volcker a hero here?
Volcker was out of office. Alan Greenspan
had
been in office for 10 weeks. David Ruder at the SEC had been in office for 10 weeks. So this was a fire drill for newbies. Some of them didn't even know each other's phone numbers as they were trying to cope on Black Monday. We got through it, but I think it's important for people to read this account and see what a near-run thing it was, how much just, you know, old-fashioned handshake relationships, trust and gentle arm twisting and diplomacy was a factor.
How do you feel the SEC and the CFTC do? It always amazed me that the Senate Agriculture Committee rules the futures, financial futures, regulatory functions.
Well, that made sense back in the early 70s when the futures markets were primarily serving the agricultural
pork
industry.
Bellies.
Yes, pork bellies, soybeans, wheat, corn. But beginning in the 70s with foreign currency futures and interest rate futures, the futures markets began to shift more and more into finance. And there was an enormous debate over who should regulate financial futures. And for purely political reasons, the CFTC won. And as a result, the SEC was steering into Black Monday without a clear and deep understanding of how the futures markets worked. Yeah. Worse than that, the futures markets had created all of these new contracts tied to the stock market that without clearly embedding in them a recognition of how the stock market worked. Just one example. Futures markets were relying on constant fresh prices for stocks out of New York. But as you know, Jim, stocks halt trading in New York all the time. Trading is halted to announce some news, or trading is halted because of an order imbalance. And when trading is halted in New York, it has an immediate impact on the staleness of the prices in Chicago, but that had not been built into the way these derivatives had been designed. So we had a rising ignorance factor between these markets and their regulators, and it was almost devastating on Black Monday.
Let me ask you this as we finish off the last minute and a half. Tell us how the fever was broken on October 20th. And lo and behold, another linkage. One of the key guys is the father of the current Treasury Secretary.
Yes. My colleague Floyd Norris at the New York Times, to whom I dedicate this book, by the way, happened to have placed himself at the Solomon Brothers trading desk that week. He was a colleague of mine at Barron's at the time. And so he was able to tip me off to this story, which I was then later able to fully confirm. Around noontime on that Tuesday, when the market was at its worst, near the breaking point, Stanley Shopcorn, who was the head of trading at Solomon Brothers and a legendary figure on the street, called his rival at Goldman Sachs, Bob Mnuchin, the father of the current Treasury Secretary, and they had a telephone conversation, after which Shopcorn stepped out to his giant trading desk, one of the marvels of the financial world, and said, "We're buying." And they started entering orders for all the big blue chip stocks that had not yet opened on the New York Stock Exchange. Started pumping hundreds of millions of dollars in the marketplace. Over at Goldman Sachs, Bob Mnuchin's trading desk was doing exactly the same thing, pumping money into the marketplace at a critical moment. And whether or not that by itself would have turned the market around is a an arguable point, but it certainly gave heart to the specialists on the New York Stock Exchange that maybe they were going to survive this. There were other things that were happening in the market at that same moment, but certainly that conversation, which I later was able to reconstruct, which was basically, for the good of the system, we've got to get some buy orders into the market. That cooperation between these two trading rivals on Wall Street certainly was part of what got us through that day.
Really put us right on the floor in that segment. We'll look in the final segment. Can the system ever be fixed? We're talking the 1987 Black Monday crash with Wall Street reporter Diana Henriques. So, Diana, who's to blame for Black Monday? And as you know, there were a bunch of conspiracy theories out there, too. So give it a shot.
Yeah, well, the conspiracy theories are always reliable to count on. They always emerge. And one of them was that there was market manipulation in one of the futures contracts still trading in Chicago. I think I pretty well debunked that theory. I tracked down the actual trades that occurred in that highly illiquid contract and explained that was a highly unlikely conspiracy. There was certainly lack of full disclosure at the New York Stock Exchange about the extent to which blue chip stocks had stopped trading, whether or not that was just a breakdown in communications or some inspired obfuscation or subterfuge at the last minute on Tuesday, October 20th, is up to the reader to decide. But certainly I saw no sign of a conspiracy either to pull the market down on Monday or to hold it up on Tuesday. What I saw instead was pluck and some luck and some necessary improvisation through that day that got people to Wednesday. But we forget that wasn't the end of the crisis. At that point, Charles Schwab was facing a ruinous loss from an options trade out of Hong Kong and was trying desperately to keep its doors open. Only regulators knew about that. We didn't. The Chicago Merc had almost failed on Tuesday, and that rumor was getting around. So the crisis really continued through the end of November, with regulators juggling hand grenades every single day. So it was we forget how desperate it was, and I hope I can bring that back to people's minds because it's important that people understand how quickly our modern markets can go south without us being really able to respond quickly enough. So
you come down that the innovation in the program trading and the futures markets and all that interplay, all of that is just that's essentially what caused the whole thing?
Yes. I mean, if you're looking for a simple explanation, it's got four components. In a fragmented regulatory system, people rewrote the rules. Giant investors using automated trading strategies and untested derivatives. Yeah. All started behaving in a herd-like way that destabilized the market. Now, by the way, I just precisely described 2008, too.
I know.
And I probably have just precisely described our next financial crisis as well. So that's what's so scary about it, is that we've learned so little about this experience.
That's where I want to go to finish up how we fix these things. The Brady report called for a single market, single regulator, or a single regulator to match the single market. And it was almost dead on arrival initially, and when I had forgotten that Greenspan was in it, really hit me after you said that. He personally had no interest in implementing that regulatory relief suggestion, right? And he was the guy that could have done it.
Absolutely. He is more responsible for the lack of a comprehensive financial regulator on the U.S. market than almost any other individual. He in his mea culpa testimony after the 2008 crisis, confessed to a belief in rational markets behaving efficiently that was totally belied by Black Monday. No one can emerge through Black Monday and believe that markets are anything other than subject to irrational moments of panic in which you cannot rely on internal forces to control them. You need, some kind of confidence-saving mechanism from the outside. So that was a disappointment to the people who led the Brady Commission. I interviewed former New Jersey Senator Nicholas Brady, who led that landmark commission for President Reagan at great length. And he was profoundly disappointed that so little was done in the aftermath of 87 to address the problems. But, after 2008, John Snow, who had been George W. Bush's Treasury Secretary, and Christopher Cox, the SEC chairman, both testified to Congress, again, that this balkanized regulatory system that we had was so dangerous, and urged that it be repaired. But again, nothing was done. It's a political problem more than a financial or regulatory
So you do call for a single regulator if it could be done.
Almost every other well-developed market in the world has a single financial regulator. They have a central bank and a financial regulator. We've got a central bank and an entire village of financial regulators.
That's a good point.
Yeah, we've got a banking regulator, a securities regulator, and an insurance regulator in every one of the 50 states before we even get to Washington.
So then another point you make, which scares me too, is you think Dodd-Frank might actually exacerbate the next crisis. I
am worried about that because in the diatribes against future bailouts, Congress, in its dubious wisdom, has enacted a rule book for the next crisis, governing who can be bailed out under what circumstances and in what way. Well, I hate to break it to them, but the next financial crisis is not going to give you time to organize an entire meeting of all the Federal Reserve chairmen in the afternoon and make a decision about this. We won't have minutes to respond. The notion that you can plan in advance for who you would rescue in a future crisis is nuts. Nobody in 1986, even in January of 1987, no one would have picked a little options clearing firm in Chicago as a financially, systemically important firm that needed to be rescued in the event of a crisis. It was totally off the radar, and yet, if it had failed, the options market would have failed. And everyone from Alan Greenspan on down was cheering Continental Illinois on as it rescued its subsidiary and kept it from failing. So you can't steer through the next crisis in the rearview mirror. So that's what worries me about the rules that are built in to the Dodd-Frank legislation. I wish Congress would take a serious look at that and consult with the experts at the Federal Reserve who know a little something about steering through financial crises and get that amended.
And it sounds like, as we finish up here, that these things are always going to come down to the folks that are in the big seats at the time.
It does. And, if we're lucky, we'll have people of the talent and personal gifts that we had in 87 and in 2008. And if we're not lucky, we won't. And it will be worse.
What a way to end it. Thanks to Diana Henriques. It's a great book. It's a whodunit, and maybe a voice in the wilderness. And as in the psychology world, there's the duty to warn, which is, if there's a danger coming, that they have a duty to warn folks. And that's kind of what this book is doing. A first-class catastrophe, the road to Black Monday, the worst day in Wall Street history. This has been Business Talk with Jim Campbell. Thanks to Diana. Thanks to our national audience for listening. We'll see everybody next Sunday on Business Talk with Jim Campbell. And welcome now to our segment 5, which is Overtime. It's exclusively for Yale Radio. The first journalist to interview Bernie Madoff in prison. Inside access to Bernie Madoff's son, Andrew Madoff, and his wife, Ruth Madoff. The latest developments in the Madoff Ponzi scandal today on Business Talk with Jim Campbell. Diana Henriques is a contributing writer at the New York Times. She specializes in investigative reporting on white-collar crime, market regulation, and corporate governance. Diana was a member of a reporting team that was named a Pulitzer finalist in 2003 for its coverage of the aftermath of the Enron scandals. She was also a member of a team that won a 1999 Gerald Loeb Award for covering the near collapse of long-term capital management, a hedge fund whose troubles rocked the financial markets in September of 1998. She was one of 4 reporters honored in 1996 by the Deadline Club, the New York City chapter of the Sigma Delta Chi Professional Journalism Society, for a series on how wealthy Americans legally sidestep taxes. She has explored the expansion of tax breaks, regulatory exemptions, and congressional earmarks for religious nonprofits, and helped monitor commodity markets and money market funds in the financial turmoil of the late 2008. University, which I, of course, have to mention because my daughter graduated from there as well. It's a great place. And it's her second visit to the show. She's a friend of the show. Really glad to have her back. Her book is The Wizard of Lies, Bernie Madoff and the Death of Trust, and the paperback version is just out, and it contains new and revised information and closer access to the...
Just a keen emotional deterioration towards the beginning of this year. As you said, that we were in email contact for more than a year, and in emails around February or so, there were some plaintive short notes saying, I'm just so depressed. I just can't get used to the being separated from my family. It was clear that his estrangement from his family, from his surviving son, Andrew, his wife of more than 60 years, Ruth, and more than 50 years, rather, Ruth, and his grandchildren have weighed very heavily on him. So I saw an emotional downturn at the beginning of the year. Now, he is suffering from stage 4 kidney disease, as I disclose in the paperback, and whether he's going to undergo the dialysis that will ultimately be necessary to sustain life with that condition remains an open question. He had told a source of mine, I'm not in the business of prolonging my life behind bars, and that's certainly understandable. On the other hand, this is a pretty big ego. Bernie Madoff is nothing if not a narcissist, and so some people think it's kind of hard to imagine him just turning his face to the wall and no longer engaging with the world, which he continues to do. So his circumstances have worsened without a doubt in terms of his physical health, in terms of his emotional health. His family, on the other hand, Jim, is starting to put some small pieces back together again in terms of normal relationships. Ruth has reconciled with her son Andrew and his children and her other grandchildren, and is trying to put her life back together again without Bernie, with no contact from Bernie. Andrew and his fiancée are putting a life together as well with a small business they've started. They're all still tied up with this massive bankruptcy process, though, and that, in the preparation for the paperback, Jim, was the more troubling thing I needed to update, was the progress and the status of that bankruptcy case that's trying to gather assets for the victims.
Again, I had not seen anywhere reported about the kidney problem, so that certainly is a major change. He's seeing a psychologist, I think you revealed too, which first surprised me that we supply that when most Americans certainly can't get that benefit.
Well, that's true. He is in a federal prison facility that is coupled with a federal hospital, a prison hospital down in Butner, North Carolina. It is a place where health services are provided for elderly white-collar criminals, and there are a number of them living there, elderly gangsters and various terrorist prisoners. So it's not surprising. You have to remember that the prison system, the federal prison system in particular, is geared towards the thesis that these prisoners are going to return to society. Now, that is not true in Madoff's case, of course. He's been sentenced to 150 years, and even if his health were better, he would never see daylight again as a free man. But most federal prisoners are not serving life terms, and so the email connections that are maintained, the psychological help, the medical care is postulated to try to prepare them to return to society in a healthier way, to not return again. And when I was sitting in the waiting room to visit Bernie for the first time, there was the guards were seeing a prisoner off. he was done. He was going home. The bus was there to take him out to return to his family. And one of the dismissing guards who was checking him out said, "Okay, kid, now make better choices in the future." So that's the mentality, and so Madoff is operating in that climate.
As recently as yesterday, somebody asked me again, why did he do it? And I know you've been very sort of insightful on the fear of failure and things. Now you've seen him when he had the weight of the world off initially in prison, and now the depression has hit him. Have you got more insight into why you think he did it?
You know, he and I have come to blows almost in tackling that issue. I lost patience with his refusal to explore the moment when he stepped over the line, the reasons, the feelings that he had about why he did it. He acknowledged that certainly his father's failures were traumatic for him, and that he realizes that may well have been a factor. But you know, he has an image of himself that I think he's desperately trying to maintain, that this was something that he almost had no choice about, that his big clients had betrayed him, they'd taken money out that he was struggling to cover, and that you know he wanted to be honest and expected to be able to return to being honest, as many Ponzi schemers do, but just couldn't. Now, I think he's being overly sympathetic with himself, frankly, Jim. I think there's a bit of self-pity in that image that does not acknowledge the kind of cold-bloodedness with which he pursued this crime. I don't know exactly when the Ponzi scheme started, but I feel absolutely certain that it started well before Madoff admits it did. So that's an issue that until he really opens up about that.
Yeah, in fact, we're going to discuss that later because you have also sort of revelations that give you more foundation for saying that. One of the things I'm interested while we're on the lies and trust issue is he clearly trusts you, and he clearly must read your books, and regularly after you quote him as saying something, you say, that's not likely to be true. And, of course, the book is A Wizard of Lies. Why do you think he trusts you?
Well, I don't know. I have wondered about this from the day he first agreed to see me. And, you know, I have to be candid. I think that any journalist would, who was self-aware would have to say, gee, does he really think he can spin me? Is that why he chose me? That he thought I would be naive enough and gullible enough that he would talk to me because he thought he could spin me? If that were the case, then obviously he would have dropped me like a rock as soon as he saw the book because he didn't spin me. But he didn't. He stayed in touch. So that thesis went out the window. It clearly wasn't because he thought I would be his amanuensis. I would just be his stenographer taking down his story and putting it between covers. So when that fell apart, I said, well, what is it then? Obviously, part of it is that I pay attention to him. I care about his story. I'm his biographer, for heaven's sake. So I do care about his story. I want to understand it and convey it as accurately and fully for history as I can. Well, that's got to be flattering to some degree to a man with an ego his size, so that may be part of it. But, of course, any author to whom he gave access would feed that need. In talking with his lawyer who helped broker our initial conversations, I've kind of come to the conclusion that part of what made me the first he spoke to was that I knew him before he was a crook. I knew who he was on Wall Street. I knew what he likes to think of as the real Bernie Madoff, the man who was the statesman, the advisor to the SEC, a man who helped truly push NASDAQ into the 21st century, moving it from an antiquated system of telephone-linked brokers out of the Dark Ages into a modern world-class marketplace. And he takes great pride in the role he and his brother Peter played in that transformation. And I knew him in that role. So unlike most of the other writers who have tried to tackle this story, who have tried to approach him over the past 3 years, I didn't just know Bernie the crook. I knew Bernie the Wall Street statesman and Bernie the crook.
That's interesting because I didn't know you knew her. I knew him. So were you completely stunned?
Oh, yes. Everybody who knew him on the street was.
Okay.
I mean, people who come now with 20/20 hindsight and say, oh, I always thought there was something a little fishy about Bernie, simply is not true. The people who had suspicions about Bernie were those who analyzed his investment results, not those who met him in person and knew him in his street role. He was a very self-deprecating, unegotistical, charming person, always good for an accessible quote. You know, he could take complexities and turn them into more simple, easily understood information. That's why regulators relied on him so much. One regulator, very senior regulator, told me, we always thought Bernie had the decoder ring. You could call him when Goldman Sachs or Morgan Stanley or somebody had given you some jive. You could call him and say, well, this is what Goldman's saying. What do you say? And he would say, oh, here's why they're saying that. Here's what they're really after. So they kind of saw him as a rebel from the Wall Street establishment, as someone who was more willing to be on the side of the regulators, which is kind of ironic when you look at where he was at that time.
Now, it's fascinating because what you've just described almost is almost schizophrenic, because you even just called him unegotistical, and before that you said, almost extreme narcissism and egotism. Is there a psychological fundamental problem?
I have always thought of this story as a Dr. Jekyll, Mr. Hyde story. Yeah. We always look sort of for the big, human prototypes. Is it a Cinderella story, a Romeo and Juliet story? This is a Dr. Jekyll and Mr. Hyde. This is a man who contained within him these two personalities driven by two very different sets of circumstances but identical needs. He needed to be admired and respected. He needed to be thought a genius and a success. Now, his real-life world on Wall Street fed that, but with the rise of hedge funds and the rise of investment management as where the action was on Wall Street, you remember that transformation, Jim, when simple trading was no longer the sexy stuff. Big firms were moving into investment management, private banking, private equity, wealth management. Well, Bernie wanted to do that too. He wanted to manage money, and he wanted to be a genius at managing money, and he wasn't. So I think his downfall came from the same set of needs, but he pursued them in these two very different personalities.
Fascinating. We'll talk a little bit now about Ruth and Andrew. Society remains very fascinated by both. You said particularly Ruth before we went on. And, of course, and I find even to my sister, people absolutely believe they were involved, they knew, et cetera. So talk a little bit about them.
Well, I've never found that thesis credible, that they were involved or that they knew. For one thing, I think the fraud began far too early for Andrew or Mark to have been present at its creation. Therefore, you wonder about the day when Bernie calls him in and sits him down and says, listen, sons, this business you think you're going to inherit? No, don't make no long-term plans here. It's a Ponzi scheme. We're all running it, and you're now in the family business of running a Ponzi scheme. Those young men would have run screaming from the room at that moment if they had been initiated into the family secret at that point. And not only that, it would have put Bernie's fate entirely in their hands, as he ultimately did when he confessed to them in 2008. They walked right out of his apartment, called a lawyer, and turned him in. So it never seemed plausible to me that those two young men were involved in the Ponzi scheme. I've heard so many times about Ruth where people say, "Oh, but she worked for him. She was his bookkeeper. She must have known. She had an office at the firm." Well, most of that is just nonsense and misunderstanding. She worked for him as his office assistant for barely 3 years before Mark was born, and then she went home and became a full-time mom. So she was never his bookkeeper. She was never privy to the backstage accounts and finagling of the business. She did have an office at the firm on a different floor. It was from there that she did the little bit of business involved in their charitable foundations, which was very late in the life of this fraud. So the prosecutors seized the computer she used there. They found nothing on it but retail activity. She did a lot of online shopping. That's about all they learned from that computer. And even moreover, Ruth worshipped Bernie. She thought he was a genius. She thought he was a wizard. He was a prince among men. She'd fallen in love with him at 13. She married him at 18. She would never have let him drag her family and her children into a massive fraud if she'd known about it. Moreover, she learned and confronted him in prison, as people will read in the paperback of Wizard of Lies, their confrontation in prison over his infidelities. She was tremendously hurt by those. She had been suspicious for years. She decided to turn a blind eye. Well, if she'd been able to drop a dime on him with prosecutors, what kind of idiot would cheat on a woman that can send you to prison? So it just never made psychological sense to me. And, of course, we're now looking more than 3 years later, not one scintilla of evidence, not one incriminating Post-it note has emerged from the 28 million documents that have been part of the Madoff trustees' enormous investigation. So, at some point, I think we just have to say, if you think they were involved, prove it, because nobody has.
Yeah, in fact, I've been able to speak with Andrew and Ruth, and I find them completely credible. And if you look under the hood, there's a lot of reasons which you can say. But to me, the big one is to tell people very simply, the feds would have loved nothing more than the perp walk Andrew right into jail on national TV, and there's not been any of that. There's been no indictment since 2008. So what does that say?
Well, it certainly says that none of the 6 confessed accomplices of Bernie's have been able to incriminate Andrew or Ruth. They're under enormous pressure. They are turning state's evidence. They're cooperating with the investigation, and so far nothing has emerged. I should say, though, as the Craig Kugel plea, that was a plea by another young staffer on the Madoff team just a few weeks ago. In that indictment, that young staffer was never accused of knowing about the Ponzi scheme. And in fact, when he confessed, he said in court he had no idea that Bernie was running a Ponzi scheme. What he was indicted for, charged with, and pleaded guilty to were filing false records with ERISA and cheating on his income tax by not reporting all the personal charges he put on the company credit cards. Well, the whole family used Madoff's firm as a piggy bank. The whole family is probably exposed to exactly those kinds of tax charges. The mystery to me is why the feds haven't brought them yet. So that did they know about the Ponzi scheme? I think I can categorically say they did not. Do they face some criminal exposure for tax violations with reference to the way Bernie ran the business? Possibly. Is the government going to go after them for those? You would expect that they would, but they haven't yet, and that's a great mystery to me.
Let me ask you about Peter Madoff, Bernie's brother, who was chief compliance officer. He was on the board of the dirty part of the business. What about him?
He has certainly been the most exposed of the family. As I report in The Wizard of Lies, he has been on notice since shortly after Madoff's arrest, that he is the subject of a criminal investigation. He's the only member of the family, by the way, who was given such notice by the prosecutors. But that notice is still operative. Craig Kugel, who pleaded guilty, worked for Peter at various times in the firm. There is an allegation in the charging documents against Kugel, the younger Kugel, that an unidentified co-conspirator knew about his charges, knew about the ERISA misbehavior. So I think we still have to wait and see on Peter's front. He was much younger than Bernie, and really the kid brother in the firm. It's hard for people who know Peter and who knew Bernie to believe that Bernie would have dragged his younger brother into a crime like this. But as we saw in the recent cases, it's quite possible that the feds will charge a crime that had nothing to do with the Ponzi scheme, and that Peter may not have known anything about the Ponzi scheme, but still face some criminal liability.
Is the SEC back on the beat?
They're certainly stronger than they were during the Madoff years, during the years that Madoff was pursuing his crime. They've got a much better system for receiving tips, a better whistleblower intake process. They've got a flatter management structure, so there are more boots on the ground, more Indians, fewer chiefs. They're using technology in some new and smart ways, which is producing some interesting cases. Their enforcement division has been empowered to serve subpoenas with less muss and fuss, and they certainly have been increasingly active in the Ponzi scheme area, in the investment management area. But, and there's a big but, it's budget. Congress still holds the purse strings. There was an effort in the aftermath of Madoff to make the SEC self-funding. You know, it's a profit center for the U.S. government. It brings in more in fees and fines than it costs, and it turns that money over to the rest of the budget. There was a proposal to allow the SEC to keep all the money it makes and to use that money to beef up its own operations, so that when markets are growing and generating more fee income for the SEC indeed can use that fee income because it's got more work to do because markets are growing. But that idea didn't fly, and so the SEC remains at the mercy of Congress for its budget. And I have been astonished at how quickly financial amnesia has set in. And members of Congress who were promising the SEC in the early 2009 that it would be given the money it needed to do the work it had to do are all of a sudden now so concerned with reducing the deficit that the SEC's budget requests are getting trimmed and cut and pared and ignored and battled over, and we're right back where we started, with the SEC struggling to get the resources it needs to do its job. So, that's the time for citizen activism. Citizens have to start asking their members of Congress, when are you going to adequately fund the SEC? What are you going to do to restore investor protection? And all we've heard in the political debate so far this year is, well, I'm going to cut regulation. I don't think that worked very well the last time, and I think we need a different answer.
Yeah, we never seem to learn. Let me ask this. There were $65 billion that was on people's statements, which obviously disappeared. $20 billion was the cash investment. What do you think, and what do Bernie think about the percentage that will ultimately be restored to investors?
Well, Bernie thinks that the cash investment, the full $20 billion, will be restored to investors. I think he's wrong. I think the legal difficulties the trustee has encountered in the courts in the past year make it problematical. But you never know. Right now he's on course for returning 57 cents on the dollar to the people who lost the $20 billion in cash out of pocket. That's $64.8 billion in wealth that evaporated in a puff of smoke the day Bernie was arrested. That's unlikely ever to be recovered. It was paper money that existed only in Bernie's imagination. And if the amount the trustee has currently raised is required to be spread over all of those losses, then the recovery will be pennies on the dollar. So we're still not over the legal hurdles. Just in the last year, appeals have been taken to the Supreme Court, to various circuit courts of appeals. That could do the trustee a great deal of damage in his efforts to recover assets. So we still have to wait and see how those appeals play out. If the trustee is upheld on the key issue of how he's calculating claims, then the net losers, the people who gave money to Bernie and never got any back, will get about 57 cents on the dollar, which is a remarkable recovery, frankly.
It is remarkable.
For a Ponzi scheme, you're usually lucky to get a few cents on the dollar. By definition, they fall apart when the money's gone, so it's usually very hard to get any of that money back. It will be remarkable and historic, just another superlative for a superlative crime.
Well, I have to say, as always, it's a fascinating and quick hour, and I know one of your messages is let's not all be blinded by our hatred of Bernie and take responsibility for our own investments as well. And as you say, the most dangerous lies are the ones we tell ourselves. Diana's book is The Wizard of Lies, Bernie Madoff and the Death of Trust. The paperback version is published by St. Martin's Press, and again, it's been updated and revised, and also she got a lot of information getting with Andrew and Ruth Madoff. This has been Business Talk with Jim Campbell on WYBC New Haven, Yale Radio 1340 AM, and streaming live at WYBCX.com. And we'll have a podcast of today's show in next week's email blast as well. Follow us on Twitter, Campbell Biz Talk, Campbell BIZ Talk. Thanks to Diana Henriques for a great interview. Thanks for listening. See you next week, everybody, on Business Talk with Jim Campbell.